Okay, so to start off, can you talk about the theoretical and practical shortcomings of Markowitz modern portfolio theory?
Yeah, so and that's in the context of what I believe strongly is a much better approach to asset allocation than what most practitioners are utilizing as sort of the workhorse method. The main shortcomings are just stepping back. There's three at the highest level. The first is Markowitz MPT is an asset only framework. How is it that the optimal asset allocation solution doesn't even consider the funding objective?
Mm.
Like what you were trying to do with those portfolio assets. So that's shortcoming number one. Shortcoming number two is that it's a single period model. It's optimal for one period, whatever that period you're optimizing around is. In most cases in practice, that's a 1 year period because we're optimizing around 1 year capital market assumptions, arithmetic means, which are technically 1 year
Mm.
returns. And then the third would be there is no kind of sound theory or good theory for constraints. And in practice, we know MPT optimizations are highly sensitive to inputs.
Right.
And so as a practical matter, you're forced to kind of impose some constraints, which is fine. All optimizations require constraints. However, the truth is, due to that input sensitivity, what ultimately happens is whatever your constraints are going to ultimately drive your asset allocation, which fundamentally overrides the theory of MPT.
Hmm.
And how far does the CAPM go in resolving the shortcomings of modern portfolio theory?
So the CAPM or the ICAPM?
CAPM.
So the CAPM still suffers from some of the shortcomings of NPT, not all of them, but then adds some additional shortcomings. So it's still an asset-only framework, the optimal CAPM portfolio. And we have to sort of differentiate the CAPM as a portfolio theory versus the CAPM as sort of a theory of pricing assets, like a factor model. So here we're talking about portfolio theory. That is one cool thing about the CAPM. It is both, it sort of unifies asset pricing and portfolio theory, so factor models and asset allocation. But to answer your question, it's still an asset-only framework. So that's one shortcoming with the CAPM. It's still a single period model. So that's a shortcoming with the CAPM. You don't have the same issues with theories of constraints because you're assuming the optimal risky portfolio is the market portfolio. So that's an improvement. But you have other problems. You have at the portfolio level, you have issues of cash aversion, where most investors don't want to actually have high allocations to cash as sort of their safe asset in a multi-asset portfolio. And then we also know empirically there's at least more than one risk factor, more than just a market factor that explains asset returns. I mean, the literature is full of them. I'm sure we're going to get to a number of them later today. But at a minimum, we know for sure there's at least a market factor for equity and equity-like assets and a term factor for high-grade bonds that are very different based on any empirical test you can run. So so solves one shortcoming, adds maybe two more.
Yeah. Okay. So you mentioned ICAPM. How does an ICAPM resolve the shortcomings of the CAPM?
Right. So in the case of the ICAPM, you have improvements over both MPT and the CAPM in the sense that now we're going to identify a funding objective, right? Maybe that funding objective, if you're a pension plan, is a liability, or an insurance company, it's a liability. Maybe if you're a private investor, it's a goal or a series of goals you're trying to fund, like lifetime consumption or gifting. But whatever we're doing, we're going to basically look at the purpose of the assets in the portfolio. Like in our view here, or I believe anyway, and here at my employer, Northern Trust, we believe essentially assets should have a purpose, right? They should serve a purpose. And that purpose is to fund something ultimately, whether it be a liability or a series of goals. So we can step back and say, we have now a funding objective. Let's construct a portfolio around that funding objective. And the optimal asset allocation solution is no longer an asset-only return versus risk perspective. It still incorporates elements of return and risk, but now in a way we're going to optimize it so that, in the most optimal way possible, we are meeting the funding objective. So the improvement or the enhancement of the ICAPM over both MPT and the CAPM is essentially now it is an asset goal or asset liability framework, a liability relative or goal relative framework, not an asset only framework. So that's enhancement number one. So in terms of doing that, now we've turned it from a single period model, say, optimal for 1 year or 1 month or whatever may be the case, and we've turned it into what we call an intertemporal or multi-year model, where it's going to be optimal over the full period, whether that's the next 10 years, the next lifetime, the next 100 years, whatever might be the case. And so in so doing, we've added or incorporated a set of liabilities or goals. They have the character of time associated with them because liabilities and goals exist through time. We're going to create an optimal portfolio around those liabilities and goals that exist through time. And so we've moved from a single period model to a multi-period model. And thirdly, we had the problem in MPT of no good theory for constraints. But with the ICAPM, like the CAPM, we can rely on kind of market efficiency, at least as a benchmark, to help us see what the optimal risky asset solution ought to be in the portfolio. So at least we can either use that and take that portfolio as the optimal risky asset / optimal return seeking portfolio, or we can use it at least as a benchmark to set constraints. So now we have a good theory for constraints and determining what that portfolio should be. So at the end of the day, you have two kind of sub portfolios, kind of this liability hedging or goal hedging portfolio and this return seeking risky asset portfolio. And you combine you construct the two in a way that's efficient relative to funding your liability or goal profile. And then you will basically select the allocation to each based on, funded status and risk tolerance. That does away with the other shortcoming of the CAPM, where investors have potentially aversion to high allocations to cash in the portfolio because we've redefined the risk-free asset. Right. It's no longer, the safe asset is no longer cash, but rather some sort of high-grade bond portfolio that's very closely cash flow aligned with the liability profile. So in that way, in a number of different ways, we've actually significantly mitigated the issues with MPT and the issues with the CAPM by moving to the ICAPM.
Mm-hmm. Okay, so you already touched on this, but maybe we can elaborate a little bit more. So how is the optimal ICAPM portfolio for a given investor different from the optimal CAPM portfolio?
Yeah, so let's start on, again, like you're right, I touched on it, but now's a great time to go into more detail. Let's start with our definition of risk and what the risk-free asset ought to be, right? So in the CAPM, the definition of risk is some concept of kind of volatility or low volatility. So that's why the risk-free asset in the CAPM is cash or treasury bills, right? That's commonly viewed as a safe asset because it has the least, or it has arguably no volatility to it, right? But in the ICAPM, that's not really the relevant definition of risk. The relevant definition of risk is a liability relative or a goal relative definition of risk, because ultimately the risk that matters is the risk around funding that final liability or that final goal profile. The risk that ultimately matters is the dispersion in final funding outcomes, right? Mm-hmm. Is there significant dispersion to future surplus or shortfall in funding outcomes? So the first most important thing is to redefine risk from this asset-only view of volatility to this liability relative risk about that really ultimately manifests as dispersion in future funding outcomes. With higher dispersion in future funding outcomes, you're more likely to fail in terms of funding that liability. And so, you can think of it that way, but another way to think about it is, what's that definition of risk? It's a different definition than standard deviation. It's something, it's actually better characterized as tracking error. So we've changed our definition of risk from asset only to liability relative by moving from standard deviation to tracking error as our definition of risk. And it's tracking error relative to funding that liability or goal profile. So what asset is risk-free in relation to funding that liability profile? Well, the asset that has no default risk and is perfectly cash flow matched with the cash flows of that liability or goal profile is your risk-free asset. So let's step back and think about it. Let's say you had a liability due in 10 years for $1 million. The asset that's risk-free relative to funding that asset might be a zero coupon 10-year treasury bond. Has no default risk, at least in theory, has no default risk, and will perfectly mature at $1 million 10 years from now, right? There's no dispersion in future funding outcomes around using that asset. It may have a lot of volatility between now and the next 10 years, right? But 10 years from now, it's going to mature at precisely $1 million and fund your liability without any risk. So very different perspectives of risk. Cash would be your definition of risk if you have an asset only view. But if you're trying to fund $1 million 10 years from now, that zero coupon 10-year treasury bond is your definition of risk. So therefore, we want to create kind of a liability hedging risk-free asset from that perspective, one that has essentially no default risk and is perfectly cash flow matched. Now, in practice, there may be very many reasons where something like that is kind of impractical. Not all maturities may be a valid. Most liability profiles are more complex than sort of a single bullet 10 years out. You can have the reality may be that not all bond maturities may be available to meet your liability or goal profile. Additionally, most bonds pay coupons, so there's reinvestment risk. There could be other practical reasons to use different types of bonds than just treasury bonds. So you can get very close to the risk-free asset in practice by using something we'll call a liability hedge instead of the true risk-free asset. So as long as you're using high-grade bonds that have very minimal default risk, and you're aligning those bonds in a way where you're at least on average duration matched, you can get very, very close to a intertemporal risk-free asset by essentially minimizing the tracking error relative to liability using high-grade bonds with minimal default risk and duration matching those bonds on average with the duration of the liability or the growth profile. So a couple of things so far, just to recap. Most importantly, with the ICAPM, we have to redefine risk to be liability or goal relative. And then we have to redefine the risk-free asset to be the asset that funds that goal or liability profile with the least amount of risk. And that's not cash. Okay. And then now we have to look at, once we've defined that portfolio, that liability hedging portfolio, that optimal liability hedging portfolio, now we can look at the rest of the portfolio and say, okay, there may be some component that I still want to bear risk around. And what is that portfolio? What's the optimal return-seeking portfolio of risky assets? And we can still optimize that portfolio relative to the liability. Now, if you're a big believer that markets are efficient, right, you essentially can take the market portfolio of risky assets to be your return-seeking portfolio in the ICAPM. However, if you choose to deviate from that market portfolio of risky assets, you can at least look to it as a benchmark to set constraints in your own optimization procedure. So you may choose to deviate because you have a different worldview about expected return and risk than maybe you see in the market portfolio of risky assets. You may deviate because you pay taxes. You may deviate for many reasons. Maybe you have other outside assets to consider, human capital, other major concentrated positions. So there could be a number of reasons you choose to deviate, but you can still use that market portfolio of risky assets to set constraints and run an optimization procedure that gives you essentially the optimal portfolio of risky assets. And so at the end of the day, you have this, this optimal liability hedging portfolio, and you also have this optimal return-seeking risky asset portfolio. And depending upon, both your risk preferences and your funded status, frankly, you can choose, what proportion of each to align with a liability or a set of goals, whether, they're higher priority or lower priority.
Okay. So walk me through practically, like I've got a client who wants to retire in 20 years. How do you allocate between the liability hedge asset and the risky assets?
Right. So it's a great question. And, there are different ways to do it, but, just getting to the core methodology of the ICAPM. What's great about it is it's a process that works both with, kind of pension plans with, singular, heterogeneous, singular homogeneous liability. And it works just as well with a private investor who has a series of kind of heterogeneous goals that have different priority levels associated with them. Some goals may be super high priority and therefore the investor wants to take less risk around them. Other goals may be more aspirational, so the investor is willing to take more risk around them. And the nice thing about the ICAPM is that you can have full hedges, you can have partial hedges, and you can have no hedges. You can fund a goal, an aspirational goal, for example, without any allocation to the goal hedging portfolio. So you can really impose your level of risk preference. So again, what you would do is, you would go through a discovery process with that investor and you'd identify and value all of their goals. And and you would understand them. So, you gave the example of, their retirement, like, their lifetime consumption and retirement. Clearly that's one goal. It might be broken down into different phases. Phase one, while they're still very active, traveling, doing many things. Phase two, while they're much older and more sedentary, there may be healthcare issues to also consider. So you can break down goals in more granular ways. You can think about gifting goals, gifts to generation 2, generation 3. You can think about gifts to your alma mater. There's all sorts of goals at the end of the day. There's a number of different ones, but at the end of the day, we're going to want to go through that process of understanding and quantifying those goals, valuing them. And that's a process of also understanding the priority level for each goal. Higher priority goals will get higher goal hedge allocations. Lower priority, more aspirational goals will generally get lower goal hedge allocations or no goal hedge allocation. Perhaps they're funded completely by the return-seeking risky asset portfolio. So, goal by goal, we can go through and understand risk preferences around them. And then at the same time, as you understand these risk preferences, we have an additional good piece of information that helps with portfolio selection, because it can give you essentially your funded status, both at the goal by goal level and in the aggregate portfolio level. We can have, depending on the assets you have and the risk you're willing to take around the goals that you're trying to fund, we have, you still at the end of the day have budget constraints. And so you can think about, how much risk I may prefer to take, or maybe how much I may need to take to fund my entire profile of goals. So there's very much a back and forth and a set of trade-offs. And as you move through the course of your life, this process is also very adaptive, and that's very important. As expected returns become realized returns, funded status may change, and you can make adaptive trade-offs and revisit the degree to which you hedge each goal. Obviously, if you completely hedge each goal, you can go away and sleep at night. You never have to make adaptive trade-offs. But the degree to which some or all goals are funded, at least in part, by the return-seeking risky asset portfolio, there's still risk around funding those goals. So adaptive trade-offs over the course of your life are still important. So at the end of the day, practically speaking, goal discovery. With each goal, we're going to identify how much of a hedge you want to impose, anywhere from 100% to fully secure those goals and never have to worry about them again, to 0%. And, for an aspirational goal, evaluate funded status and, revisit as we move through the course of your life, because you still are incurring risk to some degree in most cases to fund those goals, unless you've completely hedged away everything.
So, and do you think that's sensible for individual investors to try to fully hedge those consumption liabilities?
I don't see it in practice. I mean, especially, kind of for, your typical, so where you see investors fully hedging away their consumption liability is sort of, high net worth, ultra high net worth investors who have so much surplus assets that, oftentimes they may choose to hedge away all of their goals, and then surplus assets are the ones that are just held in the risky asset portfolio. So that's where we see it more commonly. But even in those cases, typically there may be some element of a partial hedge, even though it's largely hedged away. For many other investors, the mass affluent and normal retirement savers, that's where I get back to you may be forced to take risk to fund your retirement goals. Just be aware of the risk you're taking, how much of the goal you're hedging away and securing essentially, and the degree to which you may have to make adaptive trade-offs over the course of your life as expected return becomes realized returns. Maybe you'll get lucky and get better returns than you expected on the risky asset side. Maybe you'll be unlucky and you have to revisit your goals and modify them. So, there's value in adaptive approach. But again, the degree to which you can hedge away your goals, you don't ever have to worry about them away. You don't have to worry about them again, as long as you properly construct that goal hedge to have minimal default risk and to be duration matched on average.
What role does Monte Carlo simulation play in building ICAPM portfolios?
Yeah, you can. So getting back to portfolio selection, I talked about, you can walk through each goal. You can, identify how important each goal is to you. Is it high priority and therefore you want to take less risk around it? Is it low priority, you want to take less, maybe you're willing to take more risk around it because it's aspirational. And then I said fund status, deterministically is a way to evaluate whether or not, hey, maybe I need to take more risk around some goals because I'm underfunded unless I do. Or alternatively, like I said earlier, maybe I'm so overfunded, I have so much surplus assets that, I can hedge away more and more of my goals, right? And we see that more with kind of the ultra high net worth space. But that's a deterministic view of funded status. And the real world is stochastic, right? Or more is better represented by stochastic and Monte Carlo simulation. And so in addition to that stochastic view that helps with portfolio selection, helps with understanding funded status, we can use Monte Carlo simulation to inject risk, not so much on, there really is no risk or minimal risk on the liability hedging side. All of the risk is on the return-seeking risky asset portfolio. We're able to build Monte Carlo simulations that capture that dynamic in a complete way. So they're different than the traditional kind of MPT Monte Carlo in the sense that these ICAPM Monte Carlos capture the de minimis risk of the liability hedging portfolio and then the excess of goal risk of the risky asset portfolio. And we bring it all into the present. So that's two main differentiators, is that the risk here is risk in relation to funding the liability or goal profile, and the Monte Carlo is built that way. Your risk is tracking error, not standard deviation in this Monte Carlo. And then additionally, we bring it's not a Monte Carlo into the future, but rather a Monte Carlo that brings you to the present to augment or supplement your deterministic view of funded status. We're able to evaluate funded status stochastically via the Monte Carlo, so you can see the risk around your current funded status and the degree to which in today's dollars you have a shortfall or a surplus across the distribution of potential outcomes. We think a present value Monte Carlo is far more meaningful because most investors intuitively understand dollars they have today in terms of surplus or shortfall in terms of decision making. It's much more intuitive than thinking about dollars I might have 30 or 40 years from now.
Right.
Yeah, no, that makes sense. And how does human capital fit into ICAPM portfolio construction?
Right. And I think that, so human capital, particularly as we apply the ICAPM to goals-based investing, is really important. At the end of the day, most private investors have a lot of different potential assets that can fund their goals, right? Their lifetime goals or consumption goals, retirement, gifting goals, et cetera. And we most commonly think about in our business, their portfolio assets, their financial assets, but they may have many other assets they can use from, personal property they might have, personal assets they may have, but also most importantly with most investors, human capital, right? So the present value of future labor income. And at the end of the day, human capital is an asset and we can even capitalize it. I mean, there are other complexities around it, but we can take the value of that future labor income, bring it into the present value it, and we can look at it as an asset, just like we look at portfolio assets to help fund goals, right? And so, in an ICAPM framework, we can do it in a number of different ways. But fundamentally, at the end of the day, what we're doing in a goals-based application of an ICAPM is incorporating that asset as sort of this outside asset that funds goals, so that really the portfolio of financial assets sits right next to that portfolio of human capital assets, and both are there and enable you to fund goals. Now, it adds some complexity because there are things you have to think about. Just like we align an ICAPM portfolio, the liability hedging assets and the return-seeking risky assets with the cash flows of the goals that a client or that an investor may have, we need to do the same thing with human capital. We need to align it so that human capital funds, an investor's goals as they move through time. And this adds complexity when we have a bunch of different types of assets, portfolio assets, financial assets, and human capital assets. They need to work together and need to look at the sequencing and mix of assets and how they're funding goals, right? Different assets, how do they mix together, and how are they sequenced in terms of funding goals? So if you think about it for a second, oftentimes investors have future human capital, they save it, it goes into an investment portfolio, and then it eventually funds goals. So that's a sequence of discount rates you need to think about. Alternatively, you may have, a mix of portfolio assets and human capital assets that kind of contemporaneously fund a goal flow together. So I won't get into the technical details, but the bottom line is it's just another asset to consider that sits next to your portfolio of financial assets. And, ideally you'll capitalize it like you do. It brings it to the present. So you can think about it right next to your portfolio of financial assets in terms of how it funds goals in the future. The challenge is what is the risk of human capital? So what's the appropriate discount rate? and the complexities of sequencing it relative to all the various goal flows that compose a profile of goals or a liability, or the profile of cash flows that compose the liability. So it adds some complexity, which is why a lot of people don't actually do it, but it's really important to actually solving the optimal solution for private investors.
So I'll be honest. I've read your papers on this. I've read John Cochran's most recent paper on this, and we're not using ICAPM in practice with clients at the moment at our firm. And I don't think many practitioners are. What steps do you think practitioners should be taking to start using ICAPM in the advice they give to their clients?
Right. Well, kudos to you for reading the papers and understanding the concepts. And you mentioned John Cochran. I know he's been a guest on your podcast. I mean, a lot of my work, I'm a practitioner first and foremost. I also teach, but it's more of a side job. A lot of this research has relied on some of the original research of John Cochran, and I need to give him credit first and foremost. I think a lot of my contribution is kind of, bringing it to life in the practitioner world, kind of working out how do you take this theory, is it valid empirically, and then how does it work in practice? So you ask a great question. I think firstly, read the papers, right? An ICAPM framework for asset allocation, the Journal of Portfolio Management, an ICAPM for goals-based investing in the Journal of Wealth Management. Empirically forthcoming, I have compensated portfolio risk or the compensated risk of multi-asset portfolios forthcoming in the Journal of Portfolio Management. I think if you understand those frameworks and that concept and how it links back to the papers of Cochrane and others and the seminal research done before them, I think you'll have a really sound anchoring in the theory and frankly, the empirical evidence as to why this is a superior approach to asset allocation. Now, how do you bring it to fruition, right? The first thing I think is to start thinking about, risk from a goal relative or a liability relative perspective and start to kind of move away from standard deviation as your definition of risk. Start working with clients and explaining risk from that perspective and what might be a set of assets that really is their safe asset. It's not cash. It's going to be something that is, again, safe relative to funding their goal profile, right? So in practice, something that is composed of high grade bonds, that's duration matched on average. In theory, something with no default risk, perfectly cash flow matched with the cash flows of your liability or goals. From there, all other assets are available to create that return-seeking risky asset portfolio, right? It could be other types of low-grade bonds. High-yield bonds can be part of that return-seeking risky asset portfolio. But more commonly, equity and equity-like assets, private investments, et cetera, can all be part of that return-seeking risky asset portfolio. So thinking in terms of these two sub-portfolios, right? That safe liability hedging or goal hedging portfolio and that return-seeking risky asset portfolio. As a practitioner, how do I build each? Well, we already talked about how we can build the return-seeking risky asset, the liability hedging portfolio or the goal hedging portfolio. Next, let's talk about how do we build that return-seeking risky asset portfolio? Well, if you're a big believer in market efficiency, it's very easy. Just take a look at the, all risky asset classes out there, which is pretty much every asset class minus liability hedging assets. What is the cap-weighted market value of all of those things? What's the relative cap-weighted market value of all of those? Well, that's the market portfolio of risky assets. So if you're a big believer in market efficiency, stop, you're done. That can be your risky asset portfolio. If not, like I said, there's an optimization process that we document in the paper where, we can, for various reasons, maybe you have a unique liability profile, every investor does. So maybe your optimal return-seeking portfolio is a little different than the next person because of your liability profile. That's an important consideration. But there could be other reasons, like I said earlier. Maybe you have you're an active investor and you have a strong point of view of expected return and risk. So you want to deviate from that market portfolio. You can optimize around that. Or, additionally, you may have other real world constraints like you pay taxes or you have outside assets that are a significant portion that you can't really do much about it. And so you want to work around that. I do think that creating software around this and having an interactive approach with a client is really optimal. That's something we do here at Northern Trust. And, and I have had many RIAs, advisors reach out to me to see if we were willing to license this software. From what I understand, out there today, there really isn't something. There are goals-based approaches, but not one that's really, really well anchored to the ICAPM like we do here at my firm. But I do think a software-based approach also helps a lot, because I think it helps with that goal discovery process and working through the implications of, identifying goal hedges per goal, right? Do I want to hedge away 50%, 75%, 100% of each of those goals? And then what are the implications in real time? And then how do I make adaptive trade-offs? So I do think there's value in having a software application kind of do this real time with an investor as well.
That makes
when
sense.
we turn it to practice.
How important is it for the liability hedge asset to be like a real return asset, like TIPS in the US? And I ask the question because in Canada, we don't really have a real return bond market. The government has phased that program, or is in the process of phasing that program out. And it's just not that popular of an asset class for Canadians because of the structure of the market.
Yeah, so that's a great question. So the first thing I would say is your liability or goal nominal or real? Right? Is it inflation sensitive or not? So if you're in the world of, at least in the US, if you're in the world of pension plans, particularly corporate pension plans, like those are actually typically nominal liabilities. So you would want to use nominal bonds because you have a nominal liability you're trying to fund, right? Now you move into the world of private investors, most goals are, well, first of all, we should differentiate between sort of a legal liability like a pension plan has and a goal, which tends to be more discretionary, right?
Right.
As a goal, you have much more flexibility in how you want to fund it. But most goals are, among private investors are in fact real goals, right? They are inflation sensitive. So an optimal solution in the US anyway would use Treasury inflation protected bonds primarily. Now it's interesting because in private wealth, investors are allergic to paying taxes. So in the US in particular, there's a very strong preference for municipal bonds, but municipal bonds are subject to a significant amount of inflation risk.
Right.
At least most implementations of municipal bonds are. And so that's a problem. And behaviorally, there is the challenge in getting, high net worth investors to overcome, at least to some degree, their preference for not paying, the preference for avoiding taxes through municipal bonds by utilizing Treasury inflation protected securities. But you're right. The reality is that if you are looking for a true goal hedge that mitigates all goals, not just mismatches of duration risk, so not just undue term risk or default risk, but also inflation risk, you'd want to use inflation protected bonds. Now, you could use derivatives like swaps and things like that if you don't have a market for government inflation protected bonds. So you could use high grade bonds with swaps. You have to do a little bit of portfolio management and engineering to get there. So that's available, I believe, to you guys in Canada. But again, it requires a little bit more construction liability hedge to get there. Now, in practice, again, getting back to the US, where, again, a lot of high net worth investors have a strong preference for municipal bonds. It turns out that you don't necessarily have to have 100% TIPS allocation, because the reality is that even with TIPS, you don't, because of taxes, you don't have a perfect inflation hedge. You only have a partial inflation hedge to the degree of 1 minus the tax rate. So even then, even with TIPS, you don't have a perfect inflation hedge. So that therefore leaves room for municipal bonds in your goal hedge. It just turns out you still need a pretty material allocation to TIPS to kind of craft that optimal goal hedging portfolio. So it tends to be, in the US anyway, a mix of high grade municipal bonds and TIPS that gives you the lowest tracking error relative to funding goal profile, which will give you the least amount of dispersion in future funding outcomes.
If we can go back to a second about a few minutes ago, we were discussing human capital and it's the way it plays into ICAPM. And Ben, you said that not a lot of practitioners are using ICAPM in that way. And I just have a question about, so like with our clients, we combine risk tolerance and then risk capacity when helping to design portfolios. And risk capacity for us is more kind of quantitative, right? And when we think about human capital, we're thinking of the stability of that human capital over time, things like whether you have disability insurance in place, how risky is that income stream for the individual in the future. And obviously those who have more stable human capital might have the capacity to take on more portfolio risk. Is that a kind of a light form of implementing ICAPM?
Yeah, that's a life form. I mean, I think anything you can do, and there's more than one way to do this, right? I think anything you can do to incorporate human capital for investors that have large human capital components that are, material relative to their financial assets, I think that's good. And what you kind of identified or summarized there, I think is a good approach. All I'm saying, and I agree, like that notion of risk tolerance and risk capacity, we also use it here at Northern Trust and in our goals-based methodology. And we think about risk tolerance as something that's more psychological, right? Like different investors can have different risk tolerances, and that's something a little bit more psychological. But psychology is important to finding a portfolio that's optimal to an investor and one that they can stick through in good times and bad. But risk capacity is a little bit different, and I agree it's more quantitative. Do you have the capacity to bear risk? And a lot of times that has to do with how much surplus assets you have. So you could have a ton, you could have an ultra high net worth investor with a ton of surplus assets. They could easily fund all of their lifetime goals, regardless of what happens to the market. For example, they have a ton of risk capacity, but maybe they have, so quantitatively or financially have a huge risk capacity to bear risk. But behaviorally or psychologically, they may have low risk tolerance, right? Despite that capacity. So, and then other investors may have very little capacity to bear risk, but have high risk tolerance, right? So the two aren't necessarily highly correlated. And in kind of finding a portfolio that is optimal for an investor, you have to consider both those things. And so the ICAPM does that, in identifying your, the degree to which you want to hedge your portfolio is going to partly be based on risk preference, right, or risk tolerance. But then as you look at your funded status, the implications of funded status, both deterministically and stochastically through Monte Carlo, that gets back to risk capacity. And you may have to modify what you had picked in terms of hedging your various goals. You might have picked them, with the concept of risk tolerance in mind, but now you have to go back and modify them based on risk capacity. And all of that, getting back to your question about human capital, is important to incorporate the best you can. But really the best way ultimately to do this is to treat human capital as if it were any other asset, and any asset is really just the present value of all of its future cash flows. We can bring it back to the present, we can capitalize it, and then we can look at the sequencing of those cash flows, and we can look at our financial assets, our human capital assets, and we can construct an optimal portfolio of financial assets in consideration of the risk around your human capital. And you're right, different human capital has different levels of risk, but still we have to get back to, well, what's the right discount rate? And I don't think that has really been well established. I mean, a lot of the earlier literature has sort of argued that human capital is kind of, bond-like risk and it's safer than your financial asset portfolio. I think that's true if you had a diversified set of human capital, kind of like a diversified set of equities, which you can have in your portfolio. But the reality is that you don't. You can't diversify away your human capital. It's very unique to you as an individual. And so therefore it has a lot of idiosyncratic risk associated with it that, to me makes it, if not equity-like for most people, something more of a hybrid between sort of, a safe asset and a risky asset. Nonetheless, we've figured out ways to incorporate human capital where the discount rate doesn't necessarily matter. I think at best you can say the discount rate is abstract and nebulous, but there are other more technical ways that we can incorporate human capital so the cash flows match up regardless of what the actual discount rate is.
Mark's question made me think of another question. And Cochrane touches on this in his paper on this. If we have an investor who's very averse to dispersion around their goal, and which would then suggest a fully liability hedge portfolio with some kind of probably long-term real return bond, but they're also very averse to volatility. How do you square those two things? Because they've got on one side a preference for cash, which has a wide dispersion of outcomes, and then the other. So yeah, you get it. So how do you deal with that?
Right. No, it's a great question because, like a lot of things in our business, I think the best approach is to educate clients or investors on a number of things. It's a constant process of education, and really the first thing here is to educate the investor on the definition of risk that ultimately matters, right? If you have a liability or a goal profile you're trying to fund, the definition of risk that matters is not standard deviation or volatility. It is a goal relative definition of risk. And then you have to walk through what the implications are, right? And that's why I like to use that example of a 10-year treasury, a zero coupon 10-year treasury that's there to fund $1 million 10 years from now. Because I guarantee you that 10-year treasury is going to have some volatility far higher than cash over the next 10 years. But only that 10-year zero coupon bond is going to mature at $1 million 10 years from now and fund that liability cash flow without any risk. So education, understanding that perspective is key, and understanding that there will be some volatility between now and funding your goals. And so what we try to do is provide those illustrations, and we can show that because cash has such huge reinvestment risk, you can show that, that exact example. There's a lot of risk around funding that $1 million liability due 10 years from now if you tried to use a series of cash investments. And it's simply because you don't know what the future yields on cash are going to be. And so therefore there's a huge dispersion in that outcome. So really, I think the answer is to educate the investor on this issue, show illustrations empirically with real world data, and it helps them come around. And frankly, it provides a much better story for your bond portfolio than you might otherwise have had in an asset-only world where the lowest volatility asset is cash, and then so everyone starts thinking about, instead of using high-grade bonds, they start to migrate into lower credit quality, which in a lot of ways isn't the most optimal way to pick up the risk of a return-seeking risky asset portfolio.
Yep.
So education, I think, Ben, is the real answer. And because the truth of the matter is, there's no good way to give them both, right? You can't have a low volatility solution that's also the lowest risk asset relative to funding your goal profile, unless that goal is a year away, in which case, by the way, there is a role for cash. If that goal is within the next 12 months, cash is your optimal goal funding asset.
Yeah, I agree with all that. I think that education around volatility not always being a risk is such a big thing for investors, and I don't think most investors understand it.
Yeah, it's just stepping back, asset-only risk or goal relative risk, right?
Yep.
Standard deviation or tracking error relative to the goals. And why is tracking error important? It's because tracking error is the definition of risk that manifests through time into dispersion of future funding outcomes, which is the risk that really matters. How certain is it that you are going to successfully fund that goal?
Yeah, it's a great explanation.